Sollzins or borrowing rate is the interest rate that bank charges for issuing loan to the borrower. It could be any type of loan. In this video, I will be taking mortgage or loan against property as example. Effectivzins or effective interest rate is the sum of borrowing rate and other costs that bank may incur like property appraisal costs, transaction costs, etc. In short, as a borrower, you end up paying the effective interest rate at the end of the year. For example, if the borrowing rate is 1% per annum, after adding additional costs that bank may incur, the effective interest rate comes out to be 1.2% per annum. Then you will end up paying 1.2% as interest on your principal or loan amount per annum instead of 1%. Please note, bank may offer you insurances on top of your mortgage or loan. These insurances add further security or safety for banks in the event you are unable to pay back the loan. Usually, expenses related to these insurances, like insurance premium, are not added or included in the effective interest rate. Normally, when you go to a bank for a mortgage offer, the bank consultant only tells you the Sollzins or the borrowing rate instead of effectivzins or effective interest rate. As a borrower, however, you should always ask for and compare effective interest rate while comparing different offers from various banks. But comparing effective interest rates only makes sense when the loan amount and the credit time period or loan term is same. If that's not the case, then the comparison is incorrect. It could also be possible that the borrowing rate offered by various banks is same, however, the way banks calculate interest rate may vary. The way borrowing interest rate is calculated by banks can make a big difference in the effective interest rate. Here is an example to understand this scenario better. Let us assume you took a mortgage of $100,000 at 1% borrowing rate per annum, and you will pay a monthly installment of $1,000 to bank, which includes the principal, that is $916, and the interest, which is $84. Now, Bank 1 calculates the interest rate on the principal left, which means principal is reducing with time, and hence the interest that you will pay with time will also reduce. For example, in the first year, you will pay approximately $1,000 or 1% of $100,000 in interest. However, in second year, the interest will be reduced to $890 or 1% of $89,000. The reason for this reduced interest rate is because your principal has reduced from $100,000 to $89,000. You can also see in this image how the interest part of the borrower's monthly installment is reducing with time. In this scenario, borrower will end up paying $4,457 in total as interest. Now, there is another bank which also offers the same conditions. However, it calculates the interest on the issued loan and not on the principal left. This means that the interest portion of the monthly installment will stay the same throughout the loan term, that is $84. In this scenario, borrower will end up paying twice the interest rate she paid in the previous scenario. This is how the total interest as borrower you will pay is calculated. It will take you approximately 9 years to pay back the credit. Therefore, interest paid for 9 years will be 9 multiplied by 12 multiplied by $84, which is your interest, and the sum will come out to be $9,072, which will be your total interest that you will pay as a borrower. I think now you understand the importance of understanding how a bank will calculate or charge interest. In both scenarios, both banks offered mortgage at 1% interest rate. However, total interest borrower ends up paying is completely different. This is where effective interest rates give you a better picture. I personally calculate the total cost, that is interest plus insurance premium plus any other charges I will pay for the loan I have taken, and then compare different offers. I have seen many bank consultants who mislead their clients by using these mathematical techniques. I have also created a video on 3 warning signs of a bad consultant. I will recommend you to watch that video to protect yourself from such bank consultants. Let us now check how insurances can increase the cost of your mortgage or loan. There are different types of insurances that banks offers to the borrower along with the mortgage or loan. Sometimes taking these insurances is optional for the borrower, and sometimes it is mandatory. Here are some insurances that bank offers to the borrower. Borrower death. This is the simplest form of protection which repays the remaining loan in case of borrower's death. Incapacity for work. In this type of insurance, borrower is insured if she is not able to work anymore. Unemployment. This insurance covers the borrower in case of unemployment. Based on the type of insurance borrower takes, premium of the insurance may vary. If taking the insurance is optional, then banks do not add this expense while calculating the effective interest rate. Therefore, you have to add this expense on top of your interest rate. On the other hand, If taking insurance is required by the bank, then usually banks add this insurance cost in calculating the effective interest rate. However, I will suggest you to clarify this with your bank before coming to any conclusions. In short, you need to add the cost of the monthly premium that you will pay in your interest payments to know the total cost of your loan. For example, if your monthly interest is $84 and the monthly premium of your insurance is $16, then your total cost of the loan per month is $84 plus $16, which is $100. And here we are assuming that there are no other charges or costs involved while taking a loan. To conclude, always check the fine print of your mortgage contract and ask your bank consultant to help you in calculating the total cost of your loan. Make sure that there are no hidden costs. You can even ask your bank to provide the repayment schedule as shown here. It will help you to visualize how interest is calculated and what will be the total interest by the end of the loan term. I have also created a video on how to get a mortgage in Germany. Check it out to negotiate better with different banks and get a better offer. I hope you know more about mortgages in Germany now and can make an informed decision. If you enjoyed what you watched, help this channel to grow by liking this video. Also, your feedback matters a lot to me, so let me know in the comments what you liked and didn't like about this video.